This segment sponsored by Foster Financial. Welcome back to Women's Wealth Wednesday with Foster Financial, and we talk about an array of things that will be beneficial to your financial planning. And joining me today is Caleb Doane, their Vice President. Good morning, Caleb.
Good morning.
Welcome back.
Thanks very much.
Okay, so we've been on this talking series. I'm really talking about the basics of financial planning, and you've broken down so many different things over the weeks. And today we're going to talk about tax planning. Now, granted, we just exited tax season, but people have to really start to prepare in advance, right?
Yeah, definitely. Yeah, if somebody got hit with kind of a bigger tax bill than what they were anticipating, sometimes this is a little bit higher on the priority list after that. But yeah, there are lots of elements to a financial plan, and we like to be very holistic when we're creating financial plans. So it's not just looking at the investments, it's looking at all the other pieces that can impact your finances. And so we've talked in previous weeks about, making sure your risk is kind of appropriate, looking at your cash flow analysis, setting a target retirement date. Today we wanted to talk about tax planning or tax strategizing, which is a really important thing, whether you're working or in retirement, because taxes are probably going to be the biggest expense over the course of your life out of everything, right? You might not necessarily see it because a lot of times it just gets deducted from your paycheck, but it's the most expensive thing that you're going to have over the course of your life. So, it makes sense to spend some time on it.
Yeah, and with planning it, that's something that goes into the structure of a financial plan that you all help your clients with. But I think sometimes people may say, wait a minute, you're not a CPA.
Right.
So clearing or wanting to be clear about it, you all help prepare information that the CPA can use, right, in order to help complete the tax process?
Yeah, there's that, but there are even some, a lot of tax strategies related specifically to the investment accounts that a lot of times the CPAs, don't necessarily help with, or some CPAs don't. So when we think about Roth conversions, for example, that's where you take money in, pre-tax traditional IRA, you roll it over to a Roth IRA. That process is called a Roth conversion. It's a taxable event when you do that. And a lot of times we do that if somebody's in maybe an attractive tax bracket right now. They have a little bit of room until they hit the next tax bracket. So we'll say, all right, let's do a Roth conversion this year. A lot of times CPAs might say, hey, that's a little bit more of the investment advisor's job. Sometimes the investment advisor says, no, that's a little bit more of the CPA's job. What ends up happening is that nobody does it.
Right.
And so, we like to kind of stick our hand up and say, hey, we'll be the ones who do it. We'll do kind of the tax strategizing for the client. So Roth conversions are certainly a big piece of that, but there's a lot of other elements to it too. There's qualified charitable distributions, there's tax loss harvesting, there's just kind of, planning for big capital gains. There's a lot of elements that we like to plan for so that somebody doesn't get hit with a giant tax bill unnecessarily.
Right, and part of that is finding the loopholes or really the benefits that they can take advantage of that they may not know about.
Right.
But a lot of it I know has to do with the retirement age. So is building tax planning into your financial plan something that should be started young, or is that more so a focus when you get up to close to retirement?
Yeah, it's definitely something that can be started young, and a lot of times some of the big tax strategizing that we do, it's necessary to do it because maybe they didn't address it when they were younger. So one very common example that we see is that somebody contributes only pre-tax into their 401k. And so they have this big amount of pre-tax, money by the time that they retire, which can be a very good thing. If you have, a lot of money in your pre-tax IRA, that's a good thing, but it can be kicking the can down the road a little bit from a tax perspective once required minimum distributions start, which under current law is at 73 years old. Some of that money has to be withdrawn every single year, and taxes have to be paid on it for whatever you withdraw. And so sometimes we can do Roth conversions ahead of time to help avoid that. If we were able to start younger with folks, then maybe we'd have them contribute a little bit towards Roth and pre-tax, so then they don't have as big of RMDs once they turn 73.
Yeah, and then what about the tax planning start? So like I said, we just exited tax season. When should people start this planning to prepare them for 2026?
Oh yeah, as soon as possible.
Okay. You're like now.
Typically, yeah,
Right
exactly.
now.
Yesterday, actually. It's kind of the thing where it's never too late. Like we can still do it regardless. If somebody comes to us and they're 65 and they say, hey, I actually put in my 2 weeks yesterday, can I still do tax planning? We can certainly help with that.
Yeah.
But at the same time, it's never too early to do it either. And so if you're young and you're like, what can I be doing right now to help avoid taxes later on or be able to make some of these decisions that are going to help me in the future? We can absolutely make some small tweaks when you're younger that make just a vast difference later on.
Okay. And then if someone's watching at home and they're like, okay, I need to start thinking about my tax planning, are there any tangible tips that you can give them that they can start doing now?
Yeah, definitely. So, understanding how the different investment accounts are taxed can have a really big difference down the road. And so a lot of the investment accounts that people contribute to all have different rules when it comes to how they're taxed. So HSAs are very different than Roth IRAs, which are different than traditional IRAs, which are different than a brokerage account. And they all have unique tax rules. They have different rules on withdrawing it, different rules on how taxes are deferred in them. And so right now, if somebody's younger, a lot of times they're in their contribution years. And so they're contributing a lot to these investment accounts. Knowing which ones to contribute to is a very important piece of the plan. And so that's why, especially when people are young, we do a lot with the contribution strategizing and saying, all right, what's the priority here? Which account do we want to max out first before moving on to this next account? And it's kind of different for everybody. And so that's a big piece to focus on.
Okay, perfect. Thank you, Caleb.
Yeah, thank you.
And if you would like more information about Foster Financial, we'll have their website and their phone number listed below. Contact them for a complimentary consultation, and I'll see you after the break. This segment sponsored by Foster Financial.